Joining us now, Northwestern Mutual Wealth Management CIO, Brent Schutte. Thank you so much for being here with us, Brent. I mean, what do you make of all of this data, right? Some of it you could look at as glass half full. Some you could look at glass half empty. We got pending home sales data here today, much stronger than expected. We're still waiting for PCE, ISM, manufacturing, jobs data. Put it all together for us. And what is the picture telling you?
Yeah, I think you've had certainly a disinflationary impulse for the past, 10, 11 months that was largely driven because inflation was caused by the disequilibrium in the economy post-COVID. And so that large swing to goods and then swing to services. As you've moved further past that, inflation has come down, and that has been the positive backdrop we thought that would be for the market. Now, kind of tying into your previous conversation, I think the final frontier of inflation is wages. And that's where I think the Fed, kind of in your prior commentator's message here, I don't think the Fed stops tightening until they see wages drop sustainably, which I don't think happens, at least it hasn't in the last 3 economic cycles, until you have a recession. And that's why I think right now the times are going to get a bit tougher for the economy because the Fed isn't taking that liquidity tourniquet off until they see wages fall. And historically, that's only occurred through a recession, which we think is still highly likely.
And, we often look at things like a recession through a negative viewpoint, but is a recession kind of just a natural part of the economic cycle? I mean, would it almost be a little healthy, or is that a controversial take to say that?
I'm not for sure it's a controversial take. I mean, I think most people look back and think about recessions and think about '07 to '09, which was called great, which many of them don't get that adjective. I think the normal recession, 6 to 8 months. The thing here is, though, that it does cause job losses and typically causes earnings to fall, which causes the stock market to have some trouble. And that's where we think you're headed in the not too distant future, where you're going to see the stock market have a bit of trouble. And that's why we've been tilting our portfolios more towards fixed income, which at 5% on investment grade bonds, we think offers a real alternative to equities over the next 6 to 12 months.
Brent, you're also overweighting value. Can you talk about what sectors that lead you to?
Yeah, so we're more overweight value, so kind of staying away from those top 7 a bit more. Overweighting value in small cap and mid cap, which seems a bit ironic given the fact that I'm thinking about an economic recession. But if you think about small and mid caps, for example, we'll focus on small caps, the S&P 600. They traded about 13 times earnings, for 12-month earnings, 13 to 14 times that have already been marked down by 15%. And so I think if it's a short, shallow recession, I think the other side of this will be very good for those, especially given how cheap they are relative to their large cap counterparts. And that's where I want investors to think about adding as you kind of go through this, what I think will be a tougher period of time in the market.
Can I ask you, Brent, if you have any thoughts right now on energy? It is the sector leading the way here today, obviously in focus with the hurricane here hitting Florida right now, really as we speak.
Yeah, I mean, I think given the outlook for the globe, which I think is weaker economic growth, I have trouble believing that energy stocks are going to outperform in the coming few months. That being said, kind of tying back into my comments about thinking about the other side, I do think there will be opportunity there. And so right now it's more of a, focus more on the fixed income side, make sure your portfolio has a high amount of fixed income or appropriate amount of fixed income. Don't hide in the front end of the yield curve. I think there's value out further in the yield curve. And then think about adding to sectors such as value, small and mid cap as you go through what I think will be tougher times in the not too distant future in the equity markets.